Let's talk to Craig Erlam. He's Senior Market Analyst at OANDA. Very good morning to you, young Craig.
Good morning.
Right, dull markets. What's going on?
Well, I mean, it's chaotic, isn't it? We're finally seeing a lot of volatility in the markets. I think I saw today that it's only the third time, if you take 2008-9 as an individual, that we've seen the VIX above 50. So, I mean, these are quite unique markets that we're seeing at the moment. I think we've got a combination of factors driving what we're seeing. I think people have been waiting for so long for this to kick off that when we did see that little bit of volatility, it immediately struck fear and panic into people who thinking, we've been waiting for a 10% correction for 3, 4, 5 years. This must be it. Is it going to be more? And this panic and fear and the algos and et cetera, just really has fed into these very volatile markets. We settled a little bit yesterday. But already, as we're seeing, we see this nice little bounce back yesterday, even though futures at times were down 4 or 5% prior to the open. And then again today, it looks like Dow futures down another 300 points, could end up 600 points, who knows? I guess that's the interesting thing about the markets, is that when you do get these wild swings, they become increasingly unpredictable.
I think for me, Craig, the worry is that historically we've had lots of market makers, we've had lots of prop desks, we've had lots of day traders, we've had lots of swing traders, we've had lots of technical analysts, okay, providing liquidity. Now, it's always been said, okay, that this time around, if we did get some marked moves, there's no liquidity. That worries me.
It should worry a lot of people as well. We've seen periods of low liquidity previously, and the outcomes and the resulting swings can be quite severe.
Yep.
I think the most obvious case of that was the SNB issue that we had when the Swiss National Bank removed the floor, and liquidity really did just disappear from the markets, and we saw what kind of wild swings and ramifications that can have. So it is a concern, and you almost feel like the algos and et cetera that are there to effectively provide additional liquidity for the markets. Not only does this liquidity not seem to be apparent, it almost exacerbates the problem in the first place. So I think one of the things that we see in periods like this is that markets are improving. There's no denying that markets are improving in many, many ways, but there's also areas where there are quite significant weaknesses, and these are things going to have to be addressed. And we look at the events of the last few days, it looks as though at this moment in time, there's nothing too serious that's come out of this negatively. The Dow was falling, plummeting at one stage on Monday evening, but it seems like the ramifications have been minor at this moment in time, and hopefully it looks as though things will stabilise. But liquidity could prove to be far more of a concern later on.
Okay, so in terms of if this is a market top, okay, does it matter about Brexit? Does it matter about Bank of England meeting this week? Does it matter about, earnings out of the US of A?
Well, it does for us, especially on the Brexit front, because if this is a market top and we are going into correction, deep correction territory, then Brexit naturally isn't going to help this. People, since the 23rd of June 2016, have talked about how resilient the economy has been. They've talked about the fact that the doom and gloomers were wrong. And to an extent, they have been proven correct. It's not been doom and gloom. It's not been great. The figures show that the economy has not performed as well as other economies. But we look at the global economy and they've performed much better. So on a comparable basis, the UK still is performing poorly. I think it's just this rising tide thing. Everyone is performing better, so we just haven't fallen as far. So everything is performed better. Of course, there is a resilience factor as well. If everything else starts to fall, then I think we will start to feel the pain a lot more.
Well, I was going to say, the good thing is that the FTSE only rose 8% last year, so it was an underperformer on the global indexes. Right, let's talk about currencies. Okay, you sent a chart of the Great British Pound against the US dollar. Lots of commentary about this 140, 142 area. What are your thoughts?
I think we are back at levels that are probably representative of where we are right now. A lot of this is being dollar driven, but we are seeing a significant proportion coming from the pound as well. The Brexit risks from phase one of the agreement has been reduced. We can't deny that. They've come to some form of agreement so that they want to move on, and they've shown a desire to do so. And I think that's very important, and it's almost like one box checked. The economy has been more resilient, so that's helped the pound as well. The dollar has played a significant portion as well. So the fact that we are trading at pre-Brexit levels, we can't just attribute to that to our own resilience. As much as we love to pat ourselves on the back as Brits, we have to realise that it's not entirely a pound-related move. We look at it where we are now, and I think there's a number of things factored in which could have downside risk here. I think there's a lot of Bank of England movement priced in, for example. I think a lot of people are expecting a rate hike this year. I'm still dubious simply because I don't understand what the reasoning for this would be. Is it high inflation? Well, it's peaked. Is it strong economy? Well, it's not particularly strong. Is it a clear outlook? Well, no, it's very cloudy. I don't understand what the reasoning would be for another rate hike, even if inflation is currently still above target. We look at this now, and ahead of the Bank of England meeting tomorrow, we have come off the peak, but at the moment this looks corrective. So you've got this retracement level on there, which all it is we're just trying to highlight possible levels that the markets could come back to in a corrective move. I still think we could see 145, and we're looking at the momentum indicators at the bottom. They suggest that we're not topping per se at the moment, which is another reason why we add these levels to try and see where the market could rotate upwards. I think the market is here just preparing for the Bank of England tomorrow. It's a big decision. Not only is it an interest rate announcement, which is expected to be unchanged, it's so-called Super Thursday. We have the inflation report, which contains growth forecasts, inflation forecasts, overall economic forecasts from the Bank of England, and we also have the press conference with Mark Carney himself, the Governor of the Bank of England, and a couple of his colleagues. Here they will be discussing their projections for the economy, explaining their forecasts and answering questions. It's in these sessions, and we get these 4 times a year, when we get a much greater understanding of what the Bank of England's planning for the next 12 months. So clearly that's going to be very important both for us as an economy, but also for the pound as well.
Craig, on that note, thank you very much indeed.
Thank you.